Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
Hello everyone, this is Sean Henderson, co-head of Debt Capital Markets Asia PAC at HSBC. In this episode of Global Viewpoint, we are very lucky to have with us Laura Akers, Head of Asia PAC Corporates at Moody's in the studio. It's great to have you with us here.
Hi Sean, glad to be here.
This episode is being recorded at HSBC's Asian Credit Conference 2025. And today we're going to talk about the global credit landscape with a focus on finding value as well as the need-to-know developments in Asia. So let's get started. Laura, I think it's important to put things into context to begin the conversation. Where do you think we are in the credit cycle? And what are the macro trends that you're seeing from a rating agency perspective?
Sean, thanks for inviting me here today. Let me start by setting the scene. We publicly rate more than 400 companies in the corporate finance group in Asia Pacific, and our portfolio is spread across 17 markets and more than 17 sectors. Approximately 80% of these companies are investment grade, and what's interesting is how this has shifted over time. 5 years back, we rated around 500 companies around the region, of which only 65% were investment grade. In absolute terms, the number of investment grade companies has remained around about the same, about 330, but the high yield portfolio has shrunk by over 60% to around 75 companies. And that's mainly due to the turmoil that we have seen within the China property sector, which triggered, as you well know, a raft of restructurings, downgrades, and rating withdrawals. The flip side to this is one could argue that today, the overall quality of the portfolio in Asia Pacific is arguably far stronger than it has been before. Now, looking forward, from an outlook perspective, some 23% of the entire portfolio is on negative outlook. Although for investment grade, this is only about 20%, whereas it's about 50% for the high yield sector. There is, however, a lot of variation around the region, with 40% of Greater China issuers having a negative bias, compared to only 8% in India and 11% in Indonesia. Half of the negative base companies that we see are in the chemicals, construction, oil and gas, property and retail sectors. In addition, the negative outlook that we have on China's A1 sovereign rating has a knock-on impact on some of our rated SOEs and LGFEs within that country. It's also worth a minute or two just to look at defaults. In February, we forecast the trailing 12-month high-yield default rate for APAC to be about 4.1% at the end of 2025, flat to the end of 24, and well below the 10-year average default rate of 5.7. However, the world is changing amid tariffs and escalating geopolitical risk that has clearly impacted market volatility. So we may see some slight variations in the forecasted default rate for the year, but we don't expect it to increase materially. What is really interesting, though, is that if you look at global emerging market corporates, of which APAC emerging markets clearly play a large part, we anticipate a lower default rate for emerging markets than we do for advanced economy. This is the first time this has happened in nearly 5 years, and in part is reflective of the changing dynamics within the portfolio I mentioned earlier.
Wow, that's really interesting, Laura. I didn't realize the default rates were quite so low in Asia, and it's really encouraging. Just looking more generally at the sovereign space, you've recently downgraded the ratings for US debt. And the growing deficit is obviously a hot topic for many investors. Can you tell us a little bit more about the reasoning behind the downgrade? And does this kind of represent a fundamental shift in the US standing in the global debt markets?
Okay, it's a great question and one that we're asked an awful lot. But maybe I can just summarize some of the rationale that was behind the downgrade. So the downgrade to AA1 reflects long-term deterioration in US financial fiscal metrics. Pressure on the US's fiscal metrics have been building for years, well before our negative outlook in November 2023. Debt and interest burdens are now well above peers, and successive administrations have failed to reverse large deficits. Current fiscal proposals are unlikely to deliver meaningful sustained deficit reduction, and over the next decade, rising spending and flat revenues will drive persistently large deficits, pushing debt and interest costs even higher. Now, all of that said, the AA1 rating with a stable outlook reflects the US's enduring strengths, its large, resilient economy, the dollar's reserve currency role, and a strong institutional framework, including an independent Fed. While policy uncertainty has increased, we expect these institutional anchors to remain robust.
So comparing and contrasting the US again versus Asia, how are tariffs and geopolitics likely to impact the financial position for sovereigns within the region?
Okay, so looking beyond the US, tariffs and geopolitics are already shaping the fiscal landscape for sovereigns across Asia. We are seeing governments ramp up spending to cushion the impact of slowing growth, especially in response to tariff shocks. That's making post-pandemic fiscal consolidation more challenging. Countries such as Indonesia, Thailand, and China have already rolled out additional support. In China, for instance, stimulus measures have widened the fiscal deficit significantly in early 2025 compared to last year. Korea may follow suit, with President Lee pledging a 30 trillion won supplementary budget. But this increased spending comes at a cost. For economies still carrying elevated debt from the pandemic, the room to maneuver is limited, particularly for those reliant on external funding. And for trade or commodity-dependent countries, weakening revenues will further constrain fiscal space, even as borrowing needs rise. So while policy support is likely to continue, it will come with trade-offs, especially for sovereigns trying to balance growth with fiscal discipline.
Okay, so shifting the focus a little deeper within the economy, you recently published some research that talks about how you could see an increased default rate in emerging market corporates. Can you explain the likely impact of these tariffs on the corporate balance sheets? And are there any areas of particular concern in your view?
Okay, so before I answer the question, let me just take a step back so I can explain how we actually considered the impact of tariffs on our portfolios. We conducted a global scrub of all corporates, and we essentially looked at the direct impact of tariffs, i.e. those companies who rely on exports to the United States as a means of revenue. We also looked at the secondary order impacts, so macro, essentially a slowing economy, and thirdly, financial disruption, essentially the impact of higher bond spreads, reducing investor appetite for lower-rated company. Effectively, what that means for a company's ability to raise funds and critically to address refinancing needs. So having conducted this scrub across the region's corporates, we actually found that most APAC corporates have either limited exposure from the issue of tariffs or have sufficient mitigants in place. In fact, only 6% of our portfolio had an overall high exposure. What is important to note, though, is that overall the impact of tariffs is relatively benign for the region's corporates. In some respects, it's not surprising because many of our rated companies comprise multinational companies with globally diversified operations, or they are supported by deeply entrenched domestic market positions, supported by strong consumer demand. And also what we find is that many corporates have robust financial profiles which provide buffers in times of stress. For instance, whereas the three risk transmission channels present risks, Indian companies, for example, with a predominant domestic focus benefit from the country's favorable demographics, favorable government policies, and a funding environment that remains supportive. Similarly, in many instances, financial risk has been countered by the optionality afforded by relatively robust and deep domestic bank and bond markets, which have provided refinancing options for many of the region's corporates, even lowly rated ones. To go back to the final part of your question, which is how tariffs could increase default risks, we forecast a default rate among emerging market corporates of approximately 2.1% by the end of Q1 2026. It is likely that given the trade turmoil, default rates could end up at the higher end of our forecast, and the downside scenario takes that up to 5.2%. But the fact is, we remain past the peak in terms of the default cycle. More importantly, and I mentioned this before, but it's worth reiterating, we forecast that the default rate for advanced economies will be higher than that for emerging economies across the globe this year.
Well, that's really encouraging for Asia. And I think in light of all the volatility around tariffs, very pleasing to hear that the market is adjusting so well. One of the hot buzz topics over the last year or so has been the rise of private credit. So I'm curious, how do you see the rise of private credit affecting the public debt markets? And is the relationship between these two markets competitive, or do you see it as complementary?
Okay. High level, I would say that private credit, particularly in the region, is more complementary than competitive to public debt markets. In the main, we have seen that private credit provides funding to companies that are generally not sophisticated or large enough to be served by the public markets. They tend to replace bank credit rather than bond issuance and can serve as an additional source of funding. Private credit offers an alternative funding source to companies, especially those in niche sectors like data centers, real estate, or infrastructure lending. Others include small and medium enterprises or distressed assets. In the distressed asset cases, banks sometimes have limited appetite to extend loans. So private credit could be attractive to firms that don't have good credit ratings or are indeed unrated. This segmentation can complement public debt markets by providing capital where it might otherwise be scarce. In markets such as India, we have seen many corporates look to private credit for funding. Unrated companies in many instances, those with strained financial profiles, or those that were challenged in raising cross-border financing. But there is a cost to this.
So looking at the high yield market in particular, which is obviously very closely correlated to private credit, we've seen a good recovery in high yield volumes from the region, particularly out of jurisdictions such as Hong Kong and China, and a number of new issuers coming out of India. How does the high yield market today compare to pre-COVID times? And what are the trends that you're seeing from a rating agency perspective?
Okay, well, there's certainly been a rough few years in the high yield markets around the region. But finally, we are starting to see some signs of recovery. The worst of the China property fallout seems behind us. And while we're certainly not back to pre-COVID sentiment and probably won't ever be back there, there has been some positive momentum. Well, what's changed? For one, the market is no longer just about China property. If you think over the past 15 years or so, over 60% of issuance came from the China property space within the high yield world. But what we're now seeing is more diversity by country and sector. India and Indonesia are stepping up, and even Japan and Australia are gaining traction. In fact, following a raft of fallen angels from Japan and Korea, we are on the cusp of actually seeing a fundamental shift in the high-yield markets across the region. Defaults have also come down sharply since 2022. We find that companies are managing debt maturity profiles better, refinancing locally where it's cheaper, and that's helping credit quality. And many issuers are domestically focused, so they're less exposed to global trade tensions. So while US dollar bond issuance is muted, and pricing gaps certainly are a factor, local bank markets are filling the gap. But when issuers do go cross-border, demand has been strong, which suggests that there really is an appetite for high-yield issuance across the region. Having said all that, the same old challenges remain. Liquidity stress lingers for a few names, and rate volatility is keeping cross-border issuance in check. And let's be honest, nothing has yet filled the void left by China property, and it could be a long time before we get issuance of that magnitude from a single sector. So a full recovery is a long way off, but it is coming, albeit slowly.
And I guess given all the context and the background and the volatility and headlines, it's a pretty encouraging picture what you're painting there, and pleased to hear the demographics and the technicals of the market. I think are really helping support the underlying markets. Just to wrap things up, are there any other key events or trends that you'd really recommend we keep a close eye on for the rest of 2025 and into 2026?
Okay, well, I didn't bring a crystal ball with me, but in terms of the dynamics of the portfolio, it's worth reiterating that the APAC portfolio is dominated by investment-grade companies. In fact, 80% of our coverage. The bulk of that portfolio is also on a stable outlook. 2025 will see revenues and EBITDA grow modestly for the rated portfolio. And while debt levels will inch up slightly, leverage should remain flat to 2024 levels. If we look at tariffs, obviously we're keeping a very close eye on that. And some would say that sort of change within the tariff environment is pretty much the only constant that we are seeing. We've also got rising geopolitical risks, which continue to present risks. But we see that we are past the peak default cycle and that the impact of tariffs is relatively benign for APAC corporates. So while there is some negative bias overall, we have a cautiously optimistic view of the portfolio. Other areas to look at? High yield issuance is one. We've seen a couple of high yield deals come to market this year, including a couple of China property companies, the first such issuance for over 3 years. And also we've seen Medco as well as Vedanta come to market too. So there is definitely some appetite even for high yield issuers. So one of the other hidden gems that I think we need to think about is India. There are two sectors in particular that I think will get a lot of interest from the market: electronics and pharmaceuticals, as they are both clearly benefiting from the increased trend of supply chain diversification. A lot has been said about electronics manufacturing in India for the globe, but pharmaceuticals is another sector that would benefit, especially with India's large generics manufacturing prowess and its already established ties with generic exports to the United States. So to finish on a high note, I think you can see that there are actually a number of areas that we can look out for the positive around the region. Even though I'm a credit analyst, I do like to remain ever the optimist, cautiously optimistic in this case.
Laura, thank you so much for joining me on this episode of Global Viewpoint. It's been an absolute pleasure to talk to you today. And for our audience at home, thank you for taking the time to listen to our conversation.
Sean, thank you for having asked me here today. It's been great.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.